Hello everybody, and I hope you had a great week. This week we're going to talk about AI and how AI is no longer hype. Companies are now reporting real profits from it. Over the past 2 years, we've talked a lot about artificial intelligence and how it could increase productivity. But now we're starting to see something very important. AI is no longer just saving time, it's actually starting to increase revenue and profits for major companies. What really caught my eye this week was the Wall Street Journal article, which reported that CFOs across multiple industries are now seeing real financial returns from their AI investments. So it's not just efficiency, but it's actual measurable dollars, which is key. Executives are saying AI is helping companies automate routine work, improve decision-making, and allow employees to focus on high-value tasks, and that's really the key. And this is saving hundreds of millions of dollars. One company said AI helped generate over $300 million in savings, while others reported faster order processing, better customer service, and higher sales productivity. And this is exactly what I talked about on CNBC back on December 29th. At the time, the debate was whether AI spending was just hype, because companies were invested massive amounts of money, which they still are, but investors aren't yet seeing the payoff, and that was the issue. Now we're starting to see the payoff. What's important to understand is that major technology shifts always follow this pattern. First, you got companies spend heavily, then productivity improves, and only after that do you start to see revenue growth and profit growth. We saw it with the internet, we saw it with cloud computing, and now we're finally to start to see it with AI. Another interesting point from the article is that many companies are not even hiring more workers. They're using AI to get more output from the same number of employees, which is one of the biggest drivers of corporate profitability. This is exactly what Jensen Huang had talked about, the CEO of NVIDIA. He said specifically that AI is not necessarily going to replace workers, although some of that will happen, but workers who use AI will replace workers who do not, and that's the key. In other words, AI makes employees more productive, efficient, valuable, and when that happens across an entire company, profits will grow without adding new people. That matters for investors because productivity growth is one of the key reasons the stock market has been able to move higher over long periods of time. If companies can produce more with the same resources, it's simple, earnings will go up. When earnings go up, stock prices usually follow. Now, does that mean the market goes straight up from here? Of course not. There will be volatility and there will be periods where expectations get ahead of reality. It happens all the time. But what this tells us is that the AI cycle is moving from the hype phase into the monetization phase. And historically, that's the phase where the biggest long-term winners start to separate from the rest. That's something we're watching very closely, and it's one of the reasons we continue to focus on companies that dominate their industries, have strong cash flow, and are positioned to benefit from long-term technological trends like artificial intelligence. As always, if you have questions about how this affects your portfolio, feel free to reach out. Also, the newsletter below will also summarize what I just talked about. I hope you have a great weekend with your family.